Hey everybody. As most of you know, Jennifer Schabell with John L. Scott. I wanted to reach out to everyone and give a little insight on what this rumor of a recession may be about. So I thought I'd introduce you guys to Shane Kidwell, founder of Dwell Mortgage, to give us some insight on the so-called recession and the interest rates and things of that nature. So what is all of this about with the possible recession coming
What's
ahead?
up, Jennifer? How are you?
I'm good. How are you?
She's so gang, what she's not telling you is she is like a YouTube superstar. Hey, so I'm really good. So thank you for bringing this up. It's been a question that's been asked by a lot of people. And when you look on social media, if you watch the news or listen to the radio, there's a lot of talk about the economy and what's happening and how does that affect people that are looking to buy, sell, or refinance a property. And so I wanted to share with you a couple of leading indicators that will help people be educated on what the market's doing. Are you cool with that?
Yeah.
Okay, cool. So let's take you through a couple of slides really quick. So I really focus on two leading indicators that will help you understand what the market is going to do. The great thing about the market is the numbers really don't lie. What you're looking at is the 10-year treasury yield minus the 2-year treasury yield. Really what to think about is the 10-year treasury should earn a higher rate than a 2-year because it's obviously for a longer period of time. As you're looking at this chart, what you'll see is over time, this chart shows you the difference between the 10 and the 2. As that difference gets less and less and less, you can see here those light gray areas, which shows you when we've had a recession. As those have got to 0 and negative, it's a leading indicator that a recession is about to happen. And lo and behold, every time you've seen the 10-year versus the 2-year dip below 0, so negative % difference between the 10 and the 2, we've had a recession in this country. I think that can be pretty convoluted and complicated for a lot of people. So this one is significantly easier. Let's look at the unemployment rate. So before I show you this, Jennifer, if you were to guess, what would you think is a better indicator of an upcoming recession? High employment or low unemployment?
Of course, as most would, low unemployment rate, right?
Yeah, so what a lot of people actually get wrong is they feel like, hey, high unemployment would lead to a recession. It's actually the opposite. Low unemployment, meaning like right now we have, I think, record low unemployment, more or less, as you can see by our chart here. Once we get to the lowest level of unemployment and it starts to go back up, that every time that has happened, it's led to a recession, as you can see here. And we're going way back to 1955. Unemployment at that point hit like 2.5%. As soon as it started to go up, we had a recession. Same thing here in 1960, 1970. 75 was a pretty dramatic one. And then, of course, you saw the bubble back in 2007, 8, 9 as well. And so two key indicators to think about that are in effect right now. So we do have record low unemployment. If we see that start to tick up, that is a leading indicator that could lead to a recession. Also, back to the difference between the 10 and the 2-year treasury yield. When you look at that difference as it shrinks, going from 4 down to 3, down to 2, down to 1%, down to 0, negative %, that's always been an indicator of a recession. So as you talk to economists around the nation and around the world, as you listen to the news, it is true. We are expected to go into a recession. Some people are predicting at the end of this year. A lot of people are predicting in 2020, but it is something that's coming up in our marketplace. So the question is, well, what does that really mean for home buyers or sellers? And there's a couple of great things to keep in mind. Interest rates during a recession actually go down. So for those of you who own a home, don't plan on selling, recessions are actually a phenomenal time to do a refinance as long as you have some value. So you can see here, this is the 30-year interest rate chart over the past 50 years. Again, those areas in light gray are times of recession. As you can see, we start a recession, the rates go down. We start a recession in 1960. See, that's 1982. Newsflash, that was the year I was born. And I like to think rates went down because of my birth, but it's actually because we had a recession. So 82 happens, we have a recession, interest rates go down because, again, what the market is saying is that interest rate was too high for the affordability for homeowners. Lastly, but also very interesting, is home appreciation. So a lot of people think, and I've heard a lot of consumers say this, you know what, Shane, if we have a recession, I'm just going to hold off selling, buying, or refinancing my home. The reality is, outside of the housing bubble of 2006, 7, and 8, appreciation has gone up every time. And in fact, if you bought your home, so you always meet these people and they go, yeah, I bought my home right before the recession. Great idea that was. Well, if you take into this chart into account, let's just say that you bought your home in 2007, right as that chart was about to go down and values were going to go down. If you look, you still gain significant appreciation between then and now. So taking a macro approach of the market, a macro approach of the housing bubble that we had, you'll see that if you bought back then and you held your property, you still gained equity and value and appreciation in the property. So Jennifer, does that help kind of give you guys a base level understanding of what's going to happen and kind of what we're looking at in the market?
Yeah, it definitely does. And one thing I just wanted people to kind of know is the difference between a recession and a bubble.
Yeah.
That bubble that happened in 07 is a lot different of what is going on right now.
It's so funny you mentioned that, because a lot of people, so the financial, gurus out there will say that people don't know they're in a recession until the recession's already ended, because then you can look back at the data and go, oh my gosh, we just came out of a recession. I think we've gotten pretty smart about understanding the markets and understanding data. Now, one thing to keep in mind, and this is very different than, the bubble that we had back in the 2000s. Frankly, the loans that were getting done, and I would like to make sure everyone knows, before I was a lender, they were doing negative amortization loans. They were doing 3-2-1 buy down loans. They were doing interest only loans. There's that movie, I think it's called The Big Short. Mm-hmm. Like, that's a phenomenal movie because that's actually what happened. We had exotic dancers who were basically, they would say they had good credit. They would say, this is how much money I made, and they were able to buy a home. We don't have that anymore. After the housing crisis, we had some of the tightest restriction updates to lending guidelines that they've ever had in this country. What that means is that people right now are in good loans. In the last 9 years, I can count on a couple of hands how many adjustable rate mortgages we've done, interest only loans we've done. They're very rare. And the government really discouraged those loans. So if we do have a small, I would say, downturn in the economy, it will actually be very good for homeowners. It will help you be able to qualify for more home, because again, your interest rate is the number one thing that affects the amount of your monthly payment outside of your down payment amount. And so if rates go down, you can actually afford more home. So it's going to be a buyer's market. You'll still see homes appreciating, but that will slow down or just pause, which is okay in the short term. And interest rates are going to go down, which is going to help the consumer qualify for more homes. I think it's a great opportunity for consumers. Now, one thing to keep in mind, a lot of mortgage people now are advising that you get into loans that have points. So like if you go online right now, there's a very large online lender that has rocket ships, and the rates they quote actually show points. Here's the thing to keep in mind. If we know that a recession is on the horizon, and if we know during a recession interest rates go down, and if we know that we're going to be staying in our home, why would we not get into a rate that we could refinance out of in the next year to two? And if you're going to refinance out of your current mortgage, the worst thing you could do is get a mortgage that had points, because those are non-refundable. So the goal of getting points is to get an interest rate lower than the market has to bear. And so you're investing up front to do that. Well, if we know the market's going to adjust, and we know rates are probably going to go down, there's a lot more risk in paying points than not paying points. And so that's where we're advising our clients now to get into the lowest rate they can without paying points if they expect to keep the home and have an opportunity to refinance.
Awesome. Yeah, no, I'm so happy we touched base on this today. I just really wanted people to know, when it comes to buying, this isn't a horrible thing, because I've had some buyers, tell me, oh, well, I've heard about this going on. No, I don't want to buy yet. Or same as selling. Some people are trying to sell really fast because they think that the market's going to just totally crash, but that's not really the case in this situation.
Yeah, and I think what's really powerful for your clients to know is John L. Scott's one of the leading real estate companies in the nation for analytics and data. And some of the data that you can show your buyers and your sellers, and in partnership with Dwell Mortgage. Listen, at the end of the day, the more educated you are, the people who make great decisions in bad climates are the ones who have the most education. And so even if we have some turmoil in the market, those who are educated are going to win. And if you're working with a buyer and they're educated, they're going against a seller that's uneducated, that's fearful, your consumers are going to win. Our consumers are going to win. And that's a good thing for us and for you and for your clients.
Yes. Well, thank you so much for letting me do this here online and just giving out some info today.
Yeah, absolutely. My pleasure.
All right. Thanks.
Thanks.
Bye.